Hello, my fellow investors, and welcome back to another earnings report analysis. Today, guys, let's actually take a look at, well, one of the most anticipated earnings report of the week, and that would be none other than Netflix. They reported, and to my surprise, it actually did pretty good. I really wasn't expecting that, and their share price skyrocketed, obviously, because when a company like this does kind of okay, then it just absolutely skyrockets, like 6+%. So we're gonna take a look at the earnings, guys. Let's do a discounted free cash flow and see if for the current share price, this is looking like a buy. So with that said, let's get started with this analysis. Alright guys, coming over here to Seeking Alpha, unfortunately they do not have the updated earnings as of the 19th of January, but we can see the analyst estimates when it came to this. We got EPS normalized estimate was 54 cents, EPS gap estimate 50 cents, revenue estimate $7.85 billion, and you can see 25 analysts thought that this was actually going to miss and only one was actually going to beat. So now let's jump into the earnings to see what actually happened when it came to what they actually reported. And like always, guys, this earnings report will be linked in the description below, first page. So we got here the earnings summary. We got Q4 2022 revenue, operating profits, and membership growth exceeded our forecast. We continue to lead industry in streaming engagement, revenue, and profit. Our Q4 content slate outperformed even our high expectations. Okay, I want to see numbers. I don't understand why they don't give me the numbers straight off the bat. The bags are actually really good when it came to that. We successfully launched our new lower price ad support plan in November and are pleased with much more still to do. We delivered on the high end of our operating profits margin targets for full year 2022, and we expect to increase our operating margin in 2023 versus 2022. For 2022, we finished with 231 million paid memberships and generated $32 billion in revenue, 5.6 billion in operating income, 2 billion in net cash from operations activities, and 1.6 billion of free cash flow. Obviously, I would need to compare this to the previous year, but that doesn't look too shabby. But again, I need to compare this to the previous year. In 2023, we expect at least 3 billion in free cash flow. Okay, so they're expecting a little less than double of what they just did this year, assuming no material swing in FX. Ted Sarandos and Greg Peters are now co-CEOs of Netflix, with Reed Hastings as executive chair, completing our succession process. Okay, that's all good and dandy, but coming over here, guys, to the actual numbers, this is what I wanted to see. We got revenue in Q4 of 2020. Oh, actually, okay, so they actually, this is actually different. I've never seen the earnings before. So we got Q4 2021, so this is a year ago, $7.71 billion to $7.852 billion. That is interesting because, well, they did go up by around like $100 million, but for some reason they don't put the change over here. And then from Q3 of 2022 to Q4 of 2022, we can see that they went from 7.9 billion to 7.8 billion. I'm more interested on the year one, not necessarily quarter to quarter. On the year one, they did go up by around like $100 million. And take a look at this. They are expected forecast $8.17 billion. I actually really do like the fact that they put on the forecast over here. When it comes to the operating income, they went from 632 million to 550 million. That is a big decrease on the year, and they're expecting $1.6 billion in 2023. That's a pretty big jump. I am not a fan of that. When it comes to the net income, they went down severely, 607 million to 55 million, and they're expecting $1.27 billion in 2023. Again, that's just, I mean, come on. That's absolutely insane. And diluted EPS, guys, $1.33 Q4 2021 to 12 cents Q4 2022. That is really bad. That's a really massive decrease. And take a look at this. They're expecting $2.82 in Q1 of 2023. And here's the thing, guys, when it comes to their earnings, we can see that, well, they missed, right? When it comes to the EPS, we can see that they were expecting 54 and 50, and they did not even get close to that at all, right? In either scenario, 12 cents. So really, really bad. They missed on the earnings per share. And when it came to the revenue, they actually matched it at 7.852, and analysts were expecting $7.85 billion. So they pretty much were in line when it came to the revenue estimates. However, the EPS missed by a significant amount. Now, looking further, we actually have here the calculated free cash flow. which I really like to see as well. Q4 2021, $569 million. I'm so sorry about that. Negative $569 million in free cash flow in Q4 2021 to $332 million in free cash flow in 2022. So that was a pretty big increase. You can see they have been increasing this quarter over quarter pretty much every single time, right? I mean, they had a little bit of an outlier Q2 of 2022 where they fell to $13 million, but aside from that, they have been increasing this at least somewhat consistently. And now looking at their forecast, they said, as we noted in our Q3 2022 shareholder letter, revenue is our primary top line metric, particularly as we develop additional revenue streams where membership is just one component of our growth, like advertising and page sharing. The quarterly guidance we provide is our actual internal forecast at the time we report. As always, we strive for accuracy, although the rollout of major new initiatives, page sharing and ads, plus current uncertain macroeconomic environments leads to less than normal visibility. So the fact that they're saying that, you know, we care more about revenue than anything else, okay, that's great for them. And the fact that they were in line when it came to the revenue expectations is essentially what caused, well, their share price to essentially rocket. And we're going to take a look at that right now. So coming into the calculator, guys, we got the ticker symbol for NFLX, market cap of $140.5 billion, a P of 28.28, and a current share price of $315.78. Guys, yeah, take a look at this. Netflix earnings, stock gains 4% as subs revenues clear expectation bar. Literally, that's it. That's the only reason why they gained 4%. And actually, as if I'm recording this, they're actually up even more. So it's actually a lot more than 4%. But just because they cleared the earnings bar, that essentially makes them absolutely like skyrocket, which is just absolutely insane. Right here, you got Netflix stock has jumped 4.1% post-market following the fourth quarter earnings report, where the company easily cleared street and management expectations for subscriber growth and narrowly cleared the bar of its own newfound focus of revenue. Revenue grew 1.9% year over year to $7.85 billion. We saw this already. And the company added a net 7.66 million subscribers globally to hit 230.75 million total memberships. So, taking a look at this now, guys, on the 1 year, we can see that they're down 38.8%. Year to date, they're up 7.06%. You can see that they reached their peak here on the 13th of January at $332.82. And then they came back down to $315. However, take a look at this current share price, guys, at least post-market, 7.12% increase post-market, even though they fell on the day 3.23%. Yeah, that earnings, at least specifically that revenue, brought them up massively. 52-week range is $162.71 to $526.64. Okay, yeah, unfortunately, when you guys see those target share prices, I'm probably going to get a lot of hate, but I guess we'll cross that bridge when we get there. They do not pay out a dividend, which means that all of their cash is going straight into themselves. As you can clearly see, they are at least working to get their free cash flow up. So now, guys, let's actually go over these fundamentals really quick. Starting, of course, with the net income, 5 years ago of $1.2 billion, 1 year ago of $5 billion. That is an increase of 316%. And you can see that fairly consistent increase from 5 to 3 years ago. A pretty big jump from 3 to 2 years ago, you know, of around like, well, actually less than $3 billion or so. But that's a still pretty big jump. And then from 2 to 1 year ago, they came down by around $100 million or so. Unfortunately, because of this jump and this slight decrease over here, I'm giving this a 65%, but it doesn't look too bad. Coming into the free cash flow though, this one's looking really bad. We got 5 years ago of negative $2.8 billion to 1 year ago of $717 million. That is an increase of 125%. However, the average, it is almost negative $700. And just the fact that this is all over the place, very, very choppy. You have years of massive spikes. So like, for example, 3 years ago, obviously this was COVID year. So it's not surprising that they did $2 billion, right? But still, then they came down to negative 132 and then they're up again. So I do not like that choppiness. If it looked like the net income, I would have given it higher, but for now, I'm giving it a 10%. Looking into the revenue, this one's actually looking, I'll say it, perfect. Like, it's perfect. 5 years ago of $15.8 billion, 2 1 year ago of $31.5 billion. That is an increase of 99%. And you know what, guys? I'm giving it a 100% because that's a really good looking revenue graph, not even going to lie. And the perfectness actually continues into the total assets minus total liabilities. Really nice. This almost looks like it was like This almost looked like somebody in high school just put like 1, 2, 3, 4, 5, and like the graph just looks like perfectly smooth increasing. It really is. But you can see like from the past 5 years, consistent increase. As of today, they're up $20.5 billion in this difference. So I just said it's perfect. So you guys are seeing the number right here. But we got average total assets is $38.3 billion. Average liabilities is $26.2 billion. And doing this difference, we get $12.1 billion. As I said, guys, it's perfect. I'm giving it 100%. However, what isn't perfect is this cash flow minus the liabilities. You can see it is it's pretty much consistently decreasing, except for 2 years ago to 1 year ago, they went up slightly, but that slightly isn't big enough, guys. Average cash flow minus the average total liabilities, we get negative $24.6 billion. I'm giving this a 5%. This is not good at all. Looking now at the shares outstanding, this one, it's bad, but it's not as bad as I would think it would have been, right? I mean, this company doesn't pay the dividends, so I was expecting a lot more. They are diluting you, going from 433.4 million shares to 445 million shares, as an increase of 2.7% on the 5-year, and a little bit less than 1/4% from the previous year to the current year. Now, the reason why I said, now I'm actually giving this a 50%, and you know, 2.7%, guys, it's still a dilution, but it's not that big of a dilution. And the fact that they do not pay out a dividend, I was expecting this to be a whole lot. I was honestly expecting this increase to be like 1 decimal point over to the right, 26.8% or something like that. But the fact that it's only 2.68 in the past 5 years and they don't pay out a dividend, I'm gonna give them a 50%. I can't give them any higher because they're still diluting you, but it could have been a lot worse. And lastly, they currently hold in cash and equivalents $6.1 billion with an average of $5.3 billion. When it comes to the overall grades, we gave this net income 65%, free cash flow 10%, revenue 100%, assets minus liabilities 100%, cash flow minus liabilities 5%, shares outstanding of 50%, for an overall grade of 54. Honestly, if they would just fix their free cash flow, this would be a 70% stock, right? Like, I mean, you don't just have two 100% metrics here for no reason, right? You're obviously doing something right. However, the fact is that the cash flow is just not consistent. I get that they mainly focus on revenue, and you could see that they're mainly focusing on revenue, but I can't ignore the other profit metrics either, guys, because again, you can't just remove something that's bad of the company and then say, oh, if it wasn't for this bad part, it would be this much. No, you have to take the bad parts too. So the free cash was bad. I'm giving it a 54%. Honestly, I was expecting a lot worse. Alright guys, now let's make some assumptions, low, median, high, and use this kind of free cash flow to see if the current share price of $315, this is looking like a buy. We're going to use revenue growth and predicted share buyback assumptions with a required rate of return of 10%. Now, I already have the numbers in here, guys, but where I'm getting these revenue growths from, it's from Seeking Alpha over here. Revenue growths forward is estimated at 10.67%. So for the low, median, high, I went 8, 10, and 12%. I think that's pretty fair, right? I think that's personally pretty fair, seeing that 10% is essentially the median assumption, right? And for the predicted share buyback, well, they have been issuing shares at around 2.7%. So for the lowest one, I said, let's say that they increase it a little bit more to now 3%. For the median, let's say negative 1%. And for the highest assumption, let's say 1%. So they're going to start buying back shares. Well, with these assumptions, guys, we get the target share prices of $89.55 to $106.46. And adjusting for debt, this comes down by around $9 or so to $80.38 to $96.91. Margin of safety of 5, 10, 50%. This puts me between $68.32 to $92.07. Now, to those people, okay, to those people who say, what? It'll never fall to sub 100 or even to $100. It's 315 and right now it has gone up 7%. You are wrong. This is wrong. Okay, let's bring back, guys, that 52-week range. 162 at the lowest to $526.64. To those people that think that this can't fall to $100, well, it has already fallen from 500 plus to 150 plus. Right? That's a pretty big difference. That's a major difference. The fact that it can't fall, you know, from 315 to 106, I call it shenanigans on that. It absolutely can fall to that. Again, the reason why these numbers are getting like this is because every investment is the present value of all future cash flow. We are projecting future revenues, future net incomes, and future cash flows 4 years into the future. I don't know how many times I just said future there, but we're projecting those into the future and discounting it back to today using a certain factor. And we're putting a required rate of return that, hey, if we want to invest in this company, I want to at least match the market 10%. And with that required rate of return and assuming these revenue growth assumptions and predicted share buybacks or issuing of shares in the future, this is what you should pay for this company to get this required rate of return, assuming that they'll grow 10, 8, and 12%, not in that order, 8, 10, and 12% for the low, medium, high assumption in the future. That's all that this is saying, right? I'm not saying that the company is going to this share price. A lot of people get that confused. This is not what the share price is going to. This is the intrinsic value of the company if you want to make 10% in the next 4 years, assuming these assumptions. Every investment is the present value of all future cash flow. And from what it's looking like right now, guys, essentially Netflix is pretty expensive for what you're getting in return. Now, don't get me wrong. Does this mean that you don't pay, $315? Again, it depends, because you can see that the revenue growths are increasing very, very much, right? Like their revenue growths are just exponentially increasing, honestly, and so is their net income, not so much the free cash flow. But if you're willing to pay $315.78 for that future exponential growth, which they are apparently having, this may actually seem like a pretty good investment today. Obviously, I'm putting these revenue growths, but if you guys were to put this higher, your answer would be higher. So, for example, let's put this at like 20% for the high assumption. Now it's $137.36 with a 1% predicted share buyback. Well, if we take a look back, guys, when this thing was at 52-week lows, we did see that it was at $162.71. And by the way, that was at around May of 2022. So if you believe that this company will grow at 20% and buy back 1% of shares, you were essentially pretty close to that target share price just like about a year ago, right? So that's essentially what this is telling you. Obviously, this is not financial advice. Please make your own assumptions and please read the financial report for yourselves. Because again, all I'm giving you guys is my opinion and my opinion only. So if you guys don't believe my opinion, that's perfectly fine. That's perfectly fine. All I'm asking for is just please be respectful in the comment section below. But at the end of the day, this is what my numbers give me. And in my personal opinion, Netflix isn't the kind of company that I would buy into unless it were to fall to this kind of range. Now, you guys can have this calculator for free, as well as my book value calculator, my reevaluation calculator, and a dividend tracking sheet, because I personally want everybody to be making their own assumptions. Again, please read the quarterly earnings report. It will be linked in the description below. All I'm asking for in return, guys, for daily content, for free calculators, and now I've added a new show to the channel thanks to my friend. He's actually making technical analysis on like the market and a lot of companies. I'm growing the channel, so you guys are getting all of this for free. All I'm asking for in return is just like, subscribe, comment. It really does help. So all in all, when it comes to Netflix, again, I still think it is a pretty expensive company right now, though their fundamentals are looking a lot better, all except for that free cash flow and the cash flow minus liabilities. The shares outstanding is a little bit concerning. They are increasing it, but it's not outrageous as I thought it was. Anyways, guys, that pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow me on my YouTube sites, link in the description below. So with that said, peace out, and I will see you all in the next stock analysis video as well as earnings report.